But in terms of bond markets, Eugene, I mean, as you know, we've been having, very, very lengthy conversations at your on your investment committee. And in recent weeks and months, really, we're basically saying, the bond market may have kind of run its course for a while, and we've become a little bit more cautious on a tactical basis and winding back that duration exposure in the portfolios. Because let's just remind ourselves, in October last year, the 10-year US Treasury note yield reached 5%. And then we saw a dramatic decline in yields, which obviously leads to a dramatic increase in prices between October and the end of December. And the 10-year US Treasury yield went right down to about 3.72% from 5% in a very short period of time. And I know that in some of your portfolios, you basically wound back duration a little bit. Now, in terms of the bond yield outlook for the United States, let's just put a couple of facts on the table. What do we know? Number one, we're running a big budget deficit. How do governments finance the budget deficit? By issuing US Treasury securities. They do that on a quarterly basis in what's called the QRA, Quarterly Refunding Announcement. Now, we know it was the quarterly refunding announcement that Janet Yellen and the US Treasury announced at the end of July 2023 that set the cat amongst the pigeons and led to a sharp rise in yields because they significantly increased the amount of securities they had to issue to finance and fund that very large US budget deficit. That budget deficit hasn't gone away. Therefore, moving forward, the CBO, Congressional Budget Office, which is a nonpartisan body, is basically saying America's got a problem. They're on an unsustainable fiscal path. They can't continue to maintain these very high budget deficits because we've already got a lot of accumulated debt from prior decades. And heaven forbid, if the United States goes into a recession, we know what happens to budget deficits. They rise even more. And what the market is basically saying to the US government and the US Treasury, they're saying, you know what? If you want us to finance all this debt, you're going to have to pay us more to buy those securities. And we have this tension in the market. And I think, and I wrote this, and those clients of yours, Eugene, who very kindly subscribed to my report will know that last week I was suggesting, is it possible we go back to 5% 10-year US Treasury yields? And I think it's possible. So overnight, we traded at 4.57% on the US Treasury yield. And, and that's up markedly. Obviously, following the US CPI report, we saw quite a significant rise during the week in 10-year Treasury yields. So I'm basically now saying that I can see an environment where US Treasury yields could stretch out upwards back towards that 5% level, driven by budget deficit concerns leading to high issuance of treasuries, and also now more recently fueled by this acceleration in the rate of inflation. So that's how I'm thinking about it.
And so from a portfolio construction point of view, as you said earlier, we've become, as an investment committee, much more neutral on duration. I mean, with 10-year bond yields at around the 4.5% mark, long term, that's still reasonably attractive. But in the shorter term, we could see them going higher. Would that be fair to say, Jake?
That's a fair and reasonable characterization. Yeah. You said it in one sentence, and it took me 10 minutes.
People don't usually accuse me of being concise, but anyway. So from a portfolio construction point of view, what we did in January, as Jonathan said, we sold some duration because bond yields came down, which increases the value of bonds. We actually bought some back in February because bond yields spiked back up again. Not quite to where they are now, but pretty close. Now what we're looking to do is to actually reduce our duration exposure, because now there's kind of been this structural shift which suggests that rates are likely to stay a bit higher for a bit longer. And so, as JP said, we could see US 10-year yields go to 5% or even higher, and we'll probably see, an equivalent type of move in Australia and more broadly potentially. Although most of our exposure is the US and Australia in our portfolios via fund managers. So we are in the process, almost as we speak, of making some changes, which will essentially see both our tactical and our strategic portfolios reduce the exposure to duration, moving that money into a combination of high quality corporate bond funds, floating rate corporate bond funds. And that's significant because the fact that they're floating rate means there's no interest rate risk. So interest rates going up or down does not affect the capital value of those investments. And of course, cash, right? So, we think that represents pretty good value at the moment. It's very important in our view, if you're investing in corporate bonds, to invest in high quality liquid corporate bonds, because if we do go into recession, if there is a bit of a credit crunch, they're the least likely for you to lose money on. And in fact, they could be seen as a bit of a safe haven. So that's what we're doing over the next few days. The other thing, I'm just going to refer to my notes. The other thing that we're looking to do is to replace a few managers. So in the Aussie equity space, so we're replacing the T. Rowe Price Australian Equity Fund, which is closing, with a fund called the Airlie Australian Equity Fund. Essentially, the Airlie funds performed really, really well. And it's got a very robust and vast management team. It's had a great track record over the last 5 or 6 years. It has more of a neutral approach, which means it tends not to have a bias in terms of value or growth stocks. It just likes to pick good stocks. It has a bit of a quality bias. So they like to invest in companies that have, strong balance sheets. They're not speculative. So we're in the process of doing that. And we're also replacing an Australian Equity X20 fund, the SGH X20 fund, with another X20 fund, which is the First Sentier Australian Equity X20. X20 means they invest in Australian listed companies outside of the top 20, whereas many of the other funds in our portfolios will be very heavy, the top 20 funds. So this sort of a fund will give you that sort of exposure. Again, really good track record that these fund managers, First Sentier, have, that this particular fund has. We're very comfortable with the management. And they also have a bit of a quality bias and probably more of a growth bias, which is more common in funds that invest outside of the very big companies. So there's a few changes happening there, and they're the main changes. But broadly, we're still. The other change we're making in tactical is we've added some property and infrastructure. So until recently, that strategy, the tactical strategy, has had no exposure to listed infrastructure and listed property. So we've added, it would still be underweight relative to neutral, but we've added an exposure. Both those sectors tend to be interest rate sensitive, and given that interest rates have risen quite substantially, it probably makes sense, even though the tactical strategy remains underweight equities, it makes sense to have a little bit of exposure. We've also increased our equity exposure slightly. So the tactical strategy is still very underweight, but we have, given that, it's recession fears are probably lower than they were for us a year ago, we've sort of taken an opportunity of some of the dips in the market to try to bring that back into line a little bit, but still very underweight equities and property. On the strategic side, we haven't really changed our growth versus defensive mix in any of the portfolios, and we remain underweight. But obviously, being a strategic strategy, it's not that underweight, sort of 10 or 15% underweight. So, circling back to bonds, which are the major changes that we're about to make, this will enable us to actually go and buy some more duration. If rates or if yields spike, which is what you want to be doing, because longer term, 4.5%, 5.5%, if it gets that high, is very attractive, I think, particularly when you're looking at a high quality government bond issuer with virtually no chance of default. So that's kind of how we're positioned in terms of our portfolios.